is there a way to identify the entry and the exit point in any stock?
See, the entry and exit point of the stock is dependent upon the price versus fair value. I'm not a guy who look at the technical chart. I'm not a guy who look at the target prices. I simply look at the price versus fair value. In long term, if we see, okay, the stock has reached to a value, it has reached to a saturation point, it has discounted all the future growth and all. That could be the right point. You can churn the, your portfolio. You can replace this stock with other stock which has more potential to grow in future. And the entry point is always a point where, the price available, the price at which stock is available is less than the fair value. So it's always based on fair value versus the current market price. This is my theory.
This is the discounted flow method or the relative comparison value?
You have to use both the methods smartly, basically. Relative valuation gives you a valuation of the stock in a relative terms. Okay, how the other stocks are priced versus this particular stock, and sometimes overall market is overpriced. So even if relative valuation is indicating the particular stock is cheap or maybe undervalued, that could not be a story if you do the DC evaluation. So DC evaluation is a validation of valuation of the stock based on its fundamentals. Okay, so I always check both the methods simultaneously. For example, we did valuation of Infosys, where we saw, okay, Infosys was slightly underpriced, slightly, not much, as per the relative valuation, because other peers are priced like that. But when I do DCF, it shows, okay, currently Infosys is not underpriced if I consider current cost of capital and future growth rate. So to become underpriced as per DCF, either cost of capital has to come down or expected growth has to go up, or both should be, right? So if I see any possibility that yes, there could be a reversal in the cost of capital because we see the interest rate cycle is reversing and it is gonna to, the cost of capital is gonna to come down in future, right? So yes, I can say, okay, what market do? Market is discounting the future potential in DCF. Though you are discounting the future potential, but the cost of capital you are calculating as per the current condition. So with this sense, that's why we do sensitivity. Okay, what if this variable changes? What's the valuation? So I did sensitivity evaluation at the end and I found, okay, at 11% of the WACC, Infosys valuation is still justified. And if I see this WACC is coming in a near future, then yes, this validate, okay, both as per DCF and as per relative, this stock is good to hold. I can stay invested in the stock and I don't see big correction, rather there is a chances of moving up.